Well, at risk of being self-serving, which of course I am, the Real Classroom is very good. There's 200 hours of instructional programming there, including 11 hours of real how-to called Introduction to Natural Resource Investing. There's a lot of free sources, there's a lot of paid sources, and a lot of them are good. It's important that you consume those sources you consume sources that communicate to you. There are people out there who, I can't imagine this, Jordan, but they consider me to be an arrogant, smug human being. They probably shouldn't go to the Real Classroom. I am who I am. And if you can't consume the information from me, there are other places to get it. But the point is, do it. I think the important thing, Jordan, that people must do when they come into the sector is they have to do what you did. They have to assess themselves. They have to assess their strengths, their weaknesses, their goals, their timeframes. And then they have to begin the process of systematic education. The sector doesn't change that much. Past is prologue, but you have to do the work to understand what the past was so that you can use it as prologue. You did the work. And newbies to the sector need to ask themselves whether or not they're willing to do the work. Does it interest them? If it doesn't, if they understand the gold narrative and they want to use gold to protect themselves in the future, they should buy some gold and they should buy the best of the gold stocks, the best, and they should get on with their life. If, by contrast, they begin to get absorbed by it, they have competitive instincts or intellectual instincts like your own that suggest that they want to outcompete the beta, that they want to generate alpha, that's very different. Then they need to begin the process of outcompeting other investors. And you do that by having better access to information and a better ability to assess information. Informal tool that I've used for 30 years has been the frequency or infrequency of transactions by prospect generator. When I see prospect generators in their quarterly reports to shareholders showing increases in transactions, which is to say them being able to farm out more projects than they were a year earlier. When I see this across the length and breadth of the 40-something prospect generators that exist, I know that the game is on. I know that the financing window is open. I know that management teams who haven't taken on projects because they prefer to get paid salaries are becoming more aggressive, and that means that money is becoming available. There are probably more efficient indexes than that, but I don't know them. I follow funds by actually follow funds, which is to say, when I see transactions that are being funded by the vendors, then I know money's back in. And by the way, money's back in the space.
So you think money is now starting to come into the exploration stocks?
I know it. The second thing I see is in a very small population of high quality exploration stocks, and this has been true for 2 years, their private placements are overfunded. I'm a fairly well-known investor, and many companies tell me that having me on their register or being able to announce me in a press release is a positive for them. And I find myself, despite this alleged advantage, being cut back in financings. That's not the mark of an underfunded sector. Now, the lame, the halt, and the blind, the dross, which is 85% of the listings, they're still having difficulty raising money because the investors haven't totally taken leave of their senses yet. Most of the sector shouldn't be financed. It should be allowed to return to its intrinsic value, which is zero. But in the better part of the sector, there's a lot of money around. Interestingly, it isn't generalist money yet. When I look at the roster of investors in the better juniors, they're all names I know, or not all names I know, but the majority of the population is names I know. The second thing I'm seeing is in the very small specialist funds, the $50 or $100 million exploration funds, they're all experiencing very strong inflow of capital. I did an interview yesterday with the CEO of Agnico Eagle, and I asked him various things about their growth strategy, and he said part of it is providing equity capital for very high quality juniors. He points out that as an example, if they go into a new region or a new country, just establishing the office, hiring the people, staffing it, is $1.5 million. If he can buy, 10% or 15% of an established junior with the right to participate in the projects that they generate or whatever, that investment has, in a sense, paid for itself on day one. And you are seeing a lot of participation in the junior space from the industry itself, which is important. You're not seeing it, the kind of stocks I'm referring to, the $5 million market cap where general and administrative expense is 60% of total expenditures. You're not seeing it there, and hopefully you won't. But among the legitimate juniors, money's back in the space.
I'll start by telling you something that might seem almost embarrassingly self-serving. Education is the most valuable commodity you can buy. And not just any education, practical, time-tested, tough-love education. It's why I created my own library of resources like the Rule Classroom, which now has over 200 hours of instructional programming. But I'll tell you right now, if the sound of my voice or my style rubs you the wrong way, if you think I'm smug, arrogant, or maybe just too direct, well then my content isn't for you. There are a dozen other very fine resources out there. The point isn't where you get the education, it's that you do it. Because if there's one thing the resource sector doesn't forgive, it's ignorance. Unlike tech or meme stocks or NFT tulips, the natural resource sector is governed by immutable geological and economic laws. The rocks don't care about your feelings. The cycles don't bend to your enthusiasm. The commodities themselves are utterly indifferent to the stories spun by management teams on BNN or CNBC. They do what they do, completely agnostic to human desire. What that means is, if you come into this space without a process, without an understanding of history, without a clear assessment of your own strengths and weaknesses, you're going to get slaughtered. I say that without apology. It's happened to countless thousands of otherwise bright people. This sector separates the patient from the impulsive, the disciplined from the sloppy, and the educated from the ignorant, every time. So the first real piece of advice I give to anyone asking how to start investing in gold, silver, or junior mining stocks is this: begin with yourself. Do what my friend Jordan did, run a brutal inventory of your own psychology. Are you a trader who can stare down gut-churning volatility without flinching? Are you a long-term accumulator who can watch a position drop by half and calmly decide to double down? Do you have the patience to wait not weeks or months, but sometimes years for a thesis to play out? Most people don't, and that's perfectly okay. For them, the smart play might be as simple as buying physical gold, and the very best senior gold producers, companies with fortress balance sheets, consistent production, rising dividends, and then getting on with their life. That's the own it and sleep at night approach. But for those of you who find this game intellectually thrilling, who have that competitive streak that says, I want to outthink the crowd, I want to beat the beta and generate alpha, well, that's a different journey. That means you're not just buying gold, you're actively trying to outcompete other investors. And to do that, you need a sharper edge. You need superior access to information. You need the humility to spend thousands of hours studying past cycles so you understand exactly why past is prologue. Because let me tell you, the past truly is prologue in this sector. It doesn't change much. Governments still overspend, central banks still debase, geology still hides most of the riches, and human psychology still swings from greed to fear to regret, like a drunk on a bar stool. That's why I still lean on simple, time-tested signals. For example, I love watching the quarterly reports of prospect generators. If I see more transactions, meaning they're farming out more projects, bringing in joint venture capital, offloading risk, that tells me something powerful. It means money is flowing back into the exploration end of the sector. It means smarter institutional players are betting on new discoveries. And right now, by the way, I see exactly that. We're watching a slow but steady thaw. The capital raising window for quality exploration stocks is quietly reopening. Now, don't misunderstand me. 85% of this sector is still junk. There are tiny $5 million companies out there where 60% of every dollar raised goes straight to general and administrative expenses, paying for fancy offices and lavish conferences instead of drills in the ground. Those companies shouldn't raise money. Frankly, they should be allowed to collapse back to their intrinsic value, which is zero. But that other 15%, the small cadre of truly high-quality explorers and developers, their private placements are being oversubscribed. Even someone with my reputation and a long Rolodex of friends in the business, who many management teams still like to brag about having on their share register, finds themselves getting cut back in financings. That's a signal. It tells me smart money's returning. It's also instructive that this money isn't generalist capital yet. The big pension funds and sovereign wealth money still hasn't arrived. What we're seeing now is specialists, the same handful of names, the same hardcore funds, The same industry insiders, quietly loading up. I always say, watch what the smart money does in the early innings. When they're crowding into placements and cornering the best juniors, it tells you the clock is ticking. Eventually, the generalists will arrive, usually just in time to bid prices into the stratosphere. That's your payday, if you've done the hard work first. There's something else happening which I find very revealing. You're seeing the majors get strategic again. Just yesterday, I did an interview with the CEO of Agnico Eagle. He said, look, it costs us $1.5 million just to open up shop in a new jurisdiction. Hiring people, building out offices, sorting out the politics and the permitting. Far easier to buy 10 or 15% of a well-run junior that's already doing the heavy lifting. That equity stake, coupled with an offtake or a joint venture right, often pays for itself on day one. That's why you're seeing majors quietly putting capital to work in the highest quality juniors.
People who are technical traders, there are people who are momentum traders, there are people who are sentiment traders. That's not what I am. I'm an investor. And by education, I'm a value investor. So I use the strategy that's worked for me that I'm comfortable employing. Because I'm comfortable employing my strategies, I'm unimpacted by volatility. People that have never developed a strategy or don't follow their strategy tend to be shaken out of their investments during times when they mistake volatility for risk. So I never change what I do. There was a time in the early part of the decade of the 90s when optionality was free. Nobody expected the gold or silver price to rise. And so you could buy gold assets in the ground for $5 an ounce, $10 an ounce, understanding that if gold repriced, that those assets would underprice. That worked because nobody was buying gold optionality. People buy gold optionality now. So in order to participate in that game, you're exposed to things like $2 billion market caps, which I don't do. I'm an absolute value guy, not a relative value guy. There are lots of other ways that work for people who are good at them, but that's what works for me. It's what I understand, so it's what I do. You know, there's a whole bunch of silver dross out there. Little companies whose real exposure to silver is confined to the fact that they have silver on the name of the company and the share certificate. You know, the price of something goes up and you don't have any. It shouldn't matter very much, but I guess sentiment matters. The phenomenon that you describe is extremely important for people to understand. I experienced it personally in the early part of the decade of the 90s, where I was part of the genesis of both Silver Standard and Pan American Silver. Those two companies escalated from our first financings, 50 cents on Pan American and 72 on Silver Standard, to 5 or 6 years later, plus $40 bids. People don't understand the upside in legitimate silver juniors. They're the most volatile asset class in resources that I know of. The caveat is that you have to be involved not merely with narrative, but with high-quality people, with Ross Beatty's and Bob Quartermain's, and high-quality deposits. There are a few of those out there. I would suggest that Abra is high quality. I would suggest that Vizsla is high quality. I would suggest that Aya is high quality. And there are a couple others knocking on the door. As you suggest, a couple of the small producers, Gatos and Silvercrest, got gobbled up. That's okay. Got paid a nice premium. If you wanted, you could take shares in the acquirer so that in the run-up in silver prices, that deposit will continue to benefit you. But there's a lot to be said for doing the work to establish a 5-stock position among the silver juniors, and then just relaxing until the generalist investor comes into space. I've never seen a frenzy around anything, with the exception of uranium in 2002. That resembled the silver frenzy, the junior silver frenzy that I experienced in 1992, 1993, 1994, and 1995. It was unlike anything. I was identified as the sort of promoter between Pan American and Silver Standard. And institutional investors would call me up saying, "How are you doing this?" And I would say to them, "Well, that's a trade secret. It's not available." The truth is, I wasn't doing anything. The market went absolutely crazy. What happens in a bull market, for people who were early in the bull market, they bought a narrative before the narrative came true. As the narrative begins to be demonstrated by the price appreciation of the product in hand, that very price appreciation justifies the narrative.
So let me pick up right where we left off. If there's one thing I want to drive home, it's this. Volatility is not the same as risk. Risk is the probability of permanent loss of capital. Volatility is simply price action that unsettles people who don't have conviction, It's absolutely vital that investors in this space understand the difference. Because if you come into natural resources expecting the calm, steady grind higher you might see in a consumer staples ETF or a dividend aristocrat, you're going to be sorely disappointed. Commodities are cyclical by their very nature, and the companies that extract them are even more cyclical still. That's precisely why they can make you rich, if you have the stomach for it. Let me give you a story from my own life. I was a very young man when I first started investing in resource stocks in earnest. It was the mid-1970s. The gold price was exploding from $35 an ounce toward the hundreds. Oil was soaring from $2 to over $30. You couldn't miss. I was green and cocky and convinced that I was a genius. My testosterone-laced brain attributed my newfound wealth entirely to my skill. Well, it wasn't skill. It was a spectacular bull market that made geniuses out of everybody. And because I confused brains with a bull market, I failed to prepare for the inevitable bust. When the bottom fell out in the early 80s, I went from being a wealthy young man, on paper at least, to having a negative net worth. The markets humbled me in a way that sticks with you forever. But I thank the gods of markets every day for that lesson, because it taught me that markets work. The cure for high prices, including for gold, silver, uranium, or oil, is high prices. High prices bring on new supply. They also choke off demand. Eventually you get a bust, often as violent as the boom was joyful. If you don't understand that, if you don't position yourself accordingly, you're going to lose it all. So nowadays, I constantly check myself. When it starts to feel too easy, when the phone's ringing off the hook and people are throwing money at anything with the word gold or silver in its name, that's when I remind myself of Midland, Texas. I remember seeing that old bumper sticker after the oil crash of the 80s. God, one more bull market. I promise not to waste this one. That's been my internal compass ever since. Now let's apply that to where we stand today. The monetary circumstances we're facing are more dire than anything I've seen in my career. We've run aggregate federal debt in the United States from 30% of GDP in 1981 to about 120% today. That's an astonishing deterioration. Worse, we did it in an era when everything was going our way. From 1982 to roughly 2022, we enjoyed a multi-decade miracle. Declining real and nominal interest rates, a strong US dollar, an influx of foreign direct investment, robust equity markets. We exported our inflation to the rest of the world by virtue of our reserve currency status. But you can't run that trick forever. What we did was mortgage our future prosperity. We consume today at the expense of tomorrow, and tomorrow has arrived. The bill is due. This is why I have such conviction that hard assets, gold, silver, platinum, high-quality mining equities, farmland, energy royalties, are going to massively outperform over the next decade because the fiat system itself is being tested. The faith in government promises is being tested. And that's the root of what we're seeing in central bank gold demand. It's not complicated. They want an asset that is nobody else's liability. An ounce of gold doesn't depend on the solvency of a government. It doesn't depend on Jerome Powell's credibility. It doesn't care what the US 10-year yields. It's a piece of elemental reality forged in the hearts of dying stars that served as money for 5,000 years. Silver is a slightly different animal, and that's why I often say silver is for speculators, gold is for insurance. But silver also offers a unique asymmetry. Right now, silver trades around 1% of the gold price. Historically, it often trades at 2%. That alone means a doubling just to get back to normal. And silver, by its very nature, has always been more emotional. When silver moves, it moves violently. The best silver juniors I financed in the 90s and 2000s went from dimes to tens of dollars. It's a market that rewards early, disciplined positioning and punishes late, emotional chasing. And speaking of juniors, let's talk about them, because I get hundreds of questions every month from investors saying, Rick, should I be buying this little explorer or this $10 million drill story? And my answer always starts the same way. What do you know about it? Have you done your work? Or are you just buying a lottery ticket because you saw someone on Twitter say it was going to the moon? The junior sector is a minefield. It's also paradoxically where the life-changing money is made. That's why I love it. But you can't play it like a slot machine. You have to do the diligence. When I started Silver Standard and Pan American in the early 90s, we were buying silver ounces in the ground for less than the cost of the drill holes that proved them up. Nobody cared. That's the kind of asymmetry that turns 50-cent shares into $40 shares. But you have to be in the right companies, ones run by serially successful entrepreneurs like Ross Beatty or Bob Quartermain. Ones that have real deposits in jurisdictions where you can get a permit and build a mine. There's an entire zoo of silver juniors out there whose only real exposure to silver is that they've put it on their letterhead and in the name of the company. If the price of silver goes up and they don't have a deposit, who cares? That's why it's critical you do the work to figure out which handful are the real thing. I also pay attention to subtle market signals. For instance, right now the best juniors are having their private placements oversubscribed, and they're not being filled by Reddit hordes or Johnny-come-lately Robin Hood gamblers. They're being filled by the same cadre of specialist funds and industry veterans I've known for decades. That's a clue. The majors, too, are dipping their toes. When I spoke recently with the CEO of Agnico Eagle, he said flat out it's often cheaper for them to take a 10% or 15% equity stake in a top-tier junior than to start greenfields exploration from scratch. That tells me we're entering the phase of the cycle where smart money is quietly building positions. The fireworks with generalists come later, but you need to have the right psychology because the volatility will shake out the unprepared. Most people confuse volatility with risk. They see a stock down 30% and they panic. They sell. Often they sell to people like me who are more than happy to buy from them. In reality, the risk, the permanent impairment of capital, is often highest at the top of a cycle when everyone feels safest and lowest at the bottom when everyone is terrified. That's the contrarian's edge. And look, I'm not some Zen master. I felt fear and greed like anyone else. In the late 1970s, when gold was ripping from $35 to $850 and oil from $2 to $30, I thought I was brilliant. When it all collapsed in 1982, I found out I was simply a lucky participant in a macro boom I didn't fully understand. That lesson has stuck with me ever since. So what's my strategy now? It's very simple. I own physical gold and silver for insurance. That's my sleep-at-night capital. Then I have a carefully curated portfolio of the very best developers and explorers. Companies with real deposits, run by people with track records. I'm happy to hold through volatility because I know what I own. And I keep a chunk of capital on the sidelines because the market will give us fat pitches. It always does. When that happens, I want to be liquid and emotionally ready. It's why I tell people over and over, cash is an option on liquidity. It allows you to buy when others are forced to sell. It allows you to be greedy when others are fearful. It's the simplest edge in the world, yet few have the discipline to maintain it. Let me wrap up by addressing a common worry I hear from investors today. They say, Rick, haven't we already missed it? Gold's at all-time highs. Silver's spiking. Uranium's doubled. Is it too late? My answer is absolutely not. In fact, we're probably in the early middle innings. You're only seeing the specialist money and some industry capital stepping in. The massive flows from generalist funds and pension allocations haven't begun. When they do, these markets will look very different. The kind of moves that turn your high-quality juniors from $1 to $10 or $20 happen in the mania phase, when generalists scramble for exposure. That's still ahead. But you have to do the work now, because when the mania arrives, it will be too late to carefully build positions. You'll just be another emotional buyer, chasing momentum, vulnerable to the inevitable shakeouts. There's an old oil patch joke I love. What's the definition of a wildcatter? Someone who prays once and shoots twice. You don't want to be that guy. You want to be the disciplined accumulator, the one who patiently built his positions when nobody else cared, who did the work to understand what he owned, and who then reaps the rewards when the crowd finally wakes up. So yes, by all means, take a portion of your portfolio and protect it with physical metal. Own bullion outside the banking system. That's not a speculation, it's insurance. And if you've got the temperament, if you've got the discipline, then look to the best juniors. Not the hype machines, but the real companies with real deposits, run by serious people.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.